So Bitcoin only has users. It doesn't have any admins. There's nobody with a master key. And this is kind of the simple way of thinking about it, which is 10 years of this thing operating without anybody being in charge, and with everybody who tried to change the consensus parameters, the most important parameters of the network, everybody who tried to change these ended up basically failing. And Bitcoin has maintained its consensus parameters to the point where you could run it according to the same code that was available in 2009, and you could still make it interoperable with the current chain. And that's something that is unique about Bitcoin, which is that it is the coin that, I like to call it the immaculate conception. Somebody made these coins. Anybody could have mined the coins from the first day. They announced the currency and they said, I'm going to start running it on this day. And anybody could have joined. And since then, everybody who got Bitcoin at the market price, or because they mined it and expended resources, which roughly cost them close to what the market price was. So there are no insiders in Bitcoin.
Hello, everyone. I'm pleased today to have with me Dr. Saifedean Ammous. He's an independent economist as well as a leading researcher, communicator, and educator in the field of Bitcoin. He obtained his PhD at Columbia University. Dr. Saifedean is the author of the Bitcoin Standard, which was published in 2018, and the newly released FIAT Standard. He has advised corporations on Bitcoin strategy, helping many investors perform their due diligence on Bitcoin. Dr. Ammous teaches courses on the economics of Bitcoin and economics in the Austrian school tradition in his online learning platform, saifedean.com, and also hosts the Bitcoin Standard podcast. Thanks very much for agreeing to talk to me today, and I'm looking forward to learning a lot about things I know very little about today. So tell us maybe to begin with about your books. Let's start with the Bitcoin Standard and then move to the Fiat Standard. So the Bitcoin Standard.
Yeah, well, first of all, thank you very much for having me on. It's a true pleasure to be talking to you. I published the Bitcoin Standard in 2018, and it was a book that tried to explain the economics of Bitcoin, why Bitcoin functions, why it functions the way it does, and what are the implications that you would expect from the continued growth of Bitcoin in the future. And so I analyzed it from the perspective of the Austrian school, relying on the work of economists like Karl Menger and Ludwig von Mises, and Murray Rothbard and Joe Salerno and Friedrich Hayek. And I think the key insight that there were several key insights, but one of the most important ones in the book is that Bitcoin is the hardest money that has ever been invented, because we've essentially thrown away the algorithm for making Bitcoin work has been set at producing a certain number of Bitcoin over time that's going to end at 21 million. And there's no way of making more Bitcoins. And I think after 12 years of Bitcoin operating, we can pretty confidently say there's not going to be more than 21 million Bitcoin. And so that makes Bitcoin truly unique as a monetary asset, because it is the hardest monetary asset that we've ever found.
Let me ask you a question about that. So why is it important that limit exists? And what do you mean by hardest currency compared to other currencies?
Yeah, so the hardness here refers to the difficulty of making more currency units to add onto the existing supply. And I think this is a big deal. And essentially the first 4 chapters of my book focus on explaining why this is such a big deal. Because if you look historically at money, you find that money has been a contest of survival of the hardest. People are always looking for the hardest money available, and the ones who manage to find the hardest money manage to store their wealth in it successfully, whereas the ones who use an easy money will witness their wealth dissipate. So people will learn, but even if they don't learn, the market will brutally teach them the lesson by discounting and reducing the wealth of the people who put in the easy money. So the end result is that more and more wealth will be concentrated in the harder money. And that's why historically, when societies that had harder money came into contact with societies that had easier money, the ones with the hard money were able to essentially buy up a lot of the resources of the easy money societies, because they could continue to make more of their money and therefore devalue the money and increase the supply of it. And there are many examples in my book about this. Seashells and glass beads and limestones all were used as money when industry made them scarce in certain times and places. But then when modern technology came and allowed for an increase in their supply, their value was declining. And then in the 19th century, we see this happen between gold and silver too. The price of gold and silver used to oscillate around 15 ounces of silver per 1 ounce of gold. And in 150 years, it's now somewhere around 100. It's gotten to around 120 recently. So